When you look at your portfolio and see those returns climbing, it feels great.
Oh,
You
absolutely.
feel like you're winning the market battle. But generating positive returns is really, it's only half the challenge.
Right.
The real game, the thing that separates building modest wealth from really maximizing significant wealth, is mastering your after-tax returns.
It truly is. The goal isn't just to make money. It's to keep as much of that money as you possibly can.
And every successful investment inevitably creates a tax consequence. Understanding that isn't a chore, it's a critical piece of the strategy.
It is. The information we've collected makes it so clear. The government tax is not just your realized capital gains,
Yeah.
the profit on a sale, but also all that investment income.
Dividends, interest, all of it.
All of it.
Yeah.
And if you ignore the tax implications, you are actively leaving money on the table. So today, we're going to be dissecting two really powerful tools for this: asset placement and tax loss harvesting.
Okay, let's unpack this. Our mission is, well, it's surgical. We need to understand the dramatically different tax treatments for the three major types of income: capital gains, dividends, and interest.
Right.
And then learn how to strategically place those assets and even use losses to shrink your liability. We are diving deep into the rules, and we're starting with the most basic concept: capital gains.
Sounds good.
So capital gains are, well, they're simply the profit you make when you sell an asset, a stock, a fund, for more than you paid for it.
Correct.
But here's where it gets really interesting for every single investor. The single most important factor that determines your tax rate is just the length of time you hold that asset. It changes everything.
It's the difference between paying your normal income tax rate and getting a massive discount from the government. The threshold we use is 1 year.
1 year.
If you hold an asset for more than 1 year, so a year and a day, that profit is a long-term capital gain. And these gains get taxed at these highly preferential, much lower rates.
Like 0%, 15%, or 20%. It all depends on your income. But if you hold it for 1 year or less, that's a short-term capital gain. And this is where the tax bite really hurts.
It absolutely does.
Yeah.
Short-term gains are taxed as ordinary income. That means they're just stacked right on top of your salary.
So if you're a high earner, that rate can go all the way up to 37%.
Right, while the long-term rate maxes out at just 20%.
Okay, so let's quantify that. Let's put some numbers to it. Imagine an investor. They're in the 24% tax bracket. They have a nice $3,000 gain on a stock sale.
Okay, so if they held that stock for, say, 13 months, it's long-term.
Right.
In that 24% bracket, their capital gains rate is probably 15%. So their tax bill on that $3,000 profit is $450.
$450. Now, what if they got impatient? Sold that same stock after just 11 months for the same $3,000 profit?
Well, now that $3,000 is taxed at their ordinary income rate of 24%, the tax bill jumps to $720.
Wow, that's a $270 difference.
Just for holding on a few more weeks, you have to ask yourself, is selling early really worth that massive tax premium?
That $270 is a pretty clear motivator. But I want to clarify one interesting detail we saw about that holding period. It's not always just a simple clock, is it?
No, that's a critical anti-abuse rule. The government expects you to take genuine investment risk during that 1-year window.
Meaning?
Meaning, if you diminish your risk of loss by, let's say, using certain options or short sales against your position, those days don't count toward the holding period. It's the IRS basically saying, if you want the special rate, you have to actually own the asset and face the market risk.
That makes perfect sense. Okay, let's move on to the second major stream of investment income: dividends. Now, companies pay these out of their after-tax profits, which is why shareholders often get a break.
But the rules, as we saw, are incredibly strict.
They really are.
This is where we get the terms qualified and non-qualified dividends. The key is that qualified dividends get those same low preferential tax rates as long-term capital gains.
That 0%, 15%, or 20% max rate.
Precisely.
And what makes a dividend qualified? I think it has to do with where the company is located, right?
Primarily, yes. The company generally has to be U.S.-based or operate in a country with an acceptable double taxation treaty with the U.S.
And if it doesn't, maybe it's a company in a country without a treaty.
Then the dividend is non-qualified.
And non-qualified dividends, just like those short-term gains, get bumped up and taxed at your regular, higher, ordinary income tax rate.
Correct. Or sometimes the source of the dividend is the issue. For instance, a mutual fund might pay a dividend, but if that payout actually came from interest, the fund earned on bonds.
So it's not really a dividend from company profits.
Exactly. That portion is non-qualified income, taxed at the higher rate.
So location and source matter. But there's one more detail, and this is the one that seems to trip up so many investors. Another holding period.
Yes. And this one is even stricter than the rule for capital gains. This is where timing becomes extremely tactical.
Okay, what's the rule?
For a dividend to be qualified, you have to hold the shares for at least 61 days during a very specific 121-day period.
Whoa, okay, 61 days in a 121-day window.
And that window begins 60 days before the ex-dividend date.
Okay, wait, let's just pause on that jargon. For everyone listening, what is the ex-dividend date and why is it so important here?
The ex-dividend date is the day that a stock starts trading without the value of its next dividend payment. You have to own the stock before that date to get the dividend.
Got it.
So the IRS uses that date as a focal point to measure your holding period. It ensures you didn't just buy the stock a week before the payout, grab the dividend, and then sell it right after.
To game the system.
Exactly.
So what's the financial penalty if you miss that 61-day requirement, even by just one day?
Oh, it can be severe. Let's go back to that example we analyzed. An investor in the 35% marginal tax bracket gets a $500 dividend.
Okay.
If that dividend is qualified, the max tax rate they'll pay is 20%. So they owe up to $100 in tax.
But if they bought the stock just shy of that 61-day rule?
Then that $500 dividend instantly becomes non-qualified. It's taxed at their full 35% ordinary rate.
So the tax jumps to
$175.
Wow. What's so fascinating is that a technical rule, a tiny timing mistake, can change your tax bill by $75 on just $500 of income.
That's a huge percentage change for a very common transaction. It really highlights the power of knowing these rules.
It really does. Okay, let's switch gears completely to the third type of investment income, interest. And this one is, well, generally the least flexible.
That's right. It's the most heavily taxed. The federal government treats almost all interest income as ordinary income.
Taxed at your highest marginal rate.
Exactly. Interest from corporate bonds, your bank savings account, you name it.
I remember a really tricky detail about interest that you don't even get paid right away. What about zero coupon bonds?
That's a great nuance to remember. Zero coupon bonds, you buy them at a discount. They mature at face value, so you get no cash until the very end. And yet, the IRS requires you to pay tax annually on the interest that accrues. You are literally paying tax on money you haven't received yet.
Ouch. Okay, but there's a colossal exception to this ordinary income rule. It changes the entire game for high-income investors.
Yes, municipal bonds.
The muni bonds.
Absolutely. It's the holy grail of tax-efficient fixed income. These are bonds issued by U.S. states, cities, local municipalities.
And the interest is?
Generally exempt from federal income tax. And on top of that, if you buy a muni bond issued by an entity within your own state, that interest is often exempt from state income taxes too.
That sounds amazing. But municipal bonds usually offer a lower interest rate than, say, a corporate bond from a big company. Why would an investor choose the lower rate?
Because we only care about the after-tax return. Let's connect the dots. Take an investor in the 32% federal tax bracket.
Okay.
If they buy a corporate bond paying 5%, they get $1,000 in interest. But they immediately pay $320 of that to the IRS. Their net take-home is just $680.
$680. Now, what if that same investor puts their money into a tax-exempt municipal bond that's only paying 4%?
4% gets them $800 of interest income.
And since no federal tax is due,
Their net take-home is the full $800. The municipal bond, even with a lower interest rate, put $120 more in their pocket.
that's the power of tax efficiency right there.
Sure.
So this raises a really important question. We've just established that different assets get taxed in wildly different ways. So what does this all mean for our first key strategy, asset placement?
Well, the strategy is simple in theory, but it can be complex in execution. It's all about segregation. You want to put the most tax-inefficient assets.
The ones that get taxed at your high ordinary income rate.
Exactly. You put those inside your tax-sheltered accounts, like a traditional IRA or a 401k.
Give us some examples of those tax-inefficient assets.
Things like taxable bond funds, high-yield corporate bonds, maybe foreign stocks that pay those non-qualified dividends.
So you stick them in the 401k.
And then the interest and dividends compound entirely tax-free until you withdraw the money years later. You save yourself that 32 or 37% annual tax hit.
Okay, so you use the tax shelter, the IRA or 401k, for the stuff the IRS loves to tax the most. What about the tax-efficient assets?
They belong in your standard taxable brokerage account. Things that already get low tax rates, like domestic stocks paying qualified dividends, or those long-term capital gains. You don't want to waste that valuable tax shelter space on an asset that's already getting a tax break.
And of course, municipal bonds.
Of course. Since they're already federally tax-free, they belong in the taxable account. Putting a muni bond in an IRA is redundant, you gain no extra tax benefit, and you just limit your access to the funds.
That makes perfect sense. You're maximizing the utility of every account type. Okay, now for our second major strategic tool, a proactive one, tax loss harvesting.
An essential tool.
This is about actively creating a loss to lower your tax bill.
That's it. Tax loss harvesting is simply selling a security that's dropped below its cost basis, the original price you paid, to realize a capital loss.
And what do you do with that loss once you've realized it?
Those losses are incredibly valuable. They offset capital gains you've realized in the same year, dollar for dollar.
So if I have $10,000 in gains from my winners and $4,000 in losses from my losers.
Your net taxable gain is instantly reduced to $6,000. And if you have a net capital loss for the year, you can deduct up to $3,000 of that loss against your other income, like your salary.
And carry the rest forward.
Indefinitely.
So it sounds like an absolute no-brainer, but this is the strategy with the biggest, most punishing trap, and so many investors fall into it by accident.
The wash sale rule.
Exactly.
This is where we see attempts to save money just backfire immediately. The rule is designed to stop investors from claiming a tax loss while basically keeping their same market position.
And what does the rule say?
It says that if you sell a security for a loss, you cannot buy back that same security or one that's substantially identical within a 30-day window.
And that's 30 days before or after the sale.
It's a 61-day total blackout period, really.
And what happens if you violate that rule? If you trigger a wash sale?
The capital loss you tried to take is disallowed for the current tax year. Now, the source notes the loss isn't gone forever. It gets added to the cost basis of the new shares. It defers the benefit.
But you have to pay the tax on your gains right now.
Right now.
Let's look at the price of that impatience. So an investor has a great year. They've got $7,000 in capital gains. But they also have a $2,000 loss on another stock. Their intended net gain is $5,000.
Correct. They're expecting to pay tax on $5,000. But let's say they harvest that $2,000 loss, and then 15 days later they get nervous and buy the stock back.
They've triggered a wash sale.
Immediately. That $2,000 loss is now disallowed. They have to pay tax on the full $7,000 gain.
So if that investor is in a 35% tax bracket, and those are short-term gains, that little mistake of buying back too soon could mean paying an extra $700 in tax.
An extra $700 immediately. It's an incredibly expensive mistake. What stands out is how a rule that's meant to stop market manipulation so often trips up a regular investor just trying to do the right thing.
You have to respect that 30-day window.
You really do.
Wow. We have covered a remarkable amount of ground. We've unpacked the huge difference between short and long-term capital gains, that strict 61-day rule in the 121-day window for qualified dividends,
The power of municipal bonds in taxable accounts.
and that absolutely critical 30-day wash sale rule.
You know, if we connect this to the bigger picture, it's just clear that tax codes are always evolving and they have a profound impact on your final return.
Absolutely.
Every investor needs to realize that maximizing after-tax returns requires this level of attention to detail. Your brokerage will send you the forms, the 1099-B, 1099-DIV, 1099-INT, but understanding how to act before those forms are generated is the real differentiator.
Right. We've established that assets like Roth IRAs and HSAs can grow tax-free, and municipal bonds give you tax-exempt income. But given the highly complicated, critical nature of these specific timelines, like that 61-day dividend rule and the 30-day wash sale window, it makes me wonder how much potential return are investors losing every year simply because they aren't coordinating their investment timing with their tax strategy. That's something to mull over until our next deep dive.